Today's edition of Back Roads of Illinois. We were bringing you lasted for farming sources and information sponsored by AgriGold. We're glad you're here on a Wednesday afternoon. I'm Cesar Delgado. I am your host of today's program. Today is Liberation Day for our trade partners with Canada and China. I don't know if this works for our farmers and the economy, but we will have a great trade deficit for farmers in the United States, however it will appear in the future. Okay, I will have a conversation about the dairy markets for right now with Chris Wolf from the Department of Agriculture at Cornell University on today's program. Otherwise, this is your rural news brought by AgriGold in central Illinois and the Midwest. This week is going to have a tariffs for Canada and China with 200% tariffs for computer chip from China and lumber from Canada. However, there is uncertainty with American ag products. Today is having some severe weather as in the Midwest and Ohio Valley, the Mississippi Valley. There is a chance of a tornado in central Illinois. Finally, in Brazil, they are finishing up with the harvest season in northern parts of Brazil and Argentina. Their crop is up for yield. This been your rural news on Back Roads of Illinois. This is your commodities markets update for this afternoon, sponsored by Kyle Bumstead from Allendale Incorporated. Corn and beans, wheat are mixed. May corn is down at 3 to 6 cents. July corn is down at 5 to 9 cents. September corn is down at 8 to 5 cents. Soybean futures is under pressure on today with deferred on the trade deficit. May beans are down at 5 to 10 cents. July beans are down at 4 to 6 cents. KC May wheat is up at 5 to 10 cents. KC July wheat is up at 5 to 4 cents. Chicago May wheat is down at 3 to 6 cents. Chicago July wheat is down at 3 to 6 cents. Let's see what happens in the livestock markets. April cattle is up at 5 to 10 cents. June cattle is up at 5 to 9 cents. May feeder cattle is up at 3 to 4 cents. July feeder cattle is up at 4 to 8 cents. April hogs is down at 9 to 4 cents. June hogs is down at 5 to 4 cents. This is your commodities markets for this afternoon.
Rather than state the acres, I'm going to state the thing that I would look at if a futures market reaction to it. Right now, the DEES 2025 futures contract is trading at 440. If after the report on Monday comes out and you see that goes down 20 to 30 cents, then you would be more fully looking at PLC. And again, we're not thinking much about soybeans changing much with that report.
Do you remember that we talked about the ARC and PLC in central Illinois with Gary Schitnky? Gary Schitnky is an agricultural economist from the University of Illinois in Urbana-Champaign. He says that ARC and PLC could be down for soybeans acreage in central Illinois.
The last Friday of March, the Farm Block team held a webinar discussing the ARC PLC or Farm Safety Net decision, which is due to USDA FSA April 15. In it, University of Illinois agricultural economists Nick Paulson and Gary Schitnky made the case that farmers should choose ARC County for soybean and probably make the same decision for corn. This was before USDA's prospective plantings and grain stocks reports were released. During the webinar, Stinky was asked if the prospective plantings report corn acreage figure came in larger than expected. Actually, it did by about 1 million acres. Would that then push him to change from leaning towards our county for corn to choosing PLC?
Rather than state the acres, I'm going to state the thing that I would look at if a futures market reaction to it. Right now, the DEES 2025 futures contract is trading at 440. If after the report on Monday comes out and you see that goes down 20 to 30 cents, then you would be more fully looking at PLC. And again, we're not thinking much about soybeans changing much with that report.
The corn market, despite the unanticipated 1 million acre increase, did not break after the report. The agricultural economists at the University of Illinois still stand by their recommendations of leaning towards ARC County for corn and simply choosing ARC County for soybeans. I'm University of Illinois Extension's Todd Gleason.
He analyzes the grains markets for today's market. We're seeing prices drop down 3 cents. Soybeans prices are dropping significant, though. That would be considered for ARC and PLC for beans. The planting intention report from USDA, the corn acreage is 95 million acres with 51 bushel per acre. Soybean acreage is 83 million acres with 190 bushel per acre. Thanks to Todd Gleason from the University of Illinois by this audio.
Okay.
I will have a conversation about the dairy markets for right now with Chris Wolf from the Department of Agriculture at Cornell University. All right, Chris. How concerned about the trade deficit for dairy products in Canada?
Right. So, yeah, that's obviously a topic that's getting a lot of play in the news right now. And we're kind of waiting to see what might happen with tariffs today because we're at one of the kind of deadlines that's been set. We actually run a trade surplus on the dairy side with Canada, and we have for about 20 years now. Canada has a strict production quota that keeps their farm milk price at 1.5 to 2 times what our farm milk price is. And the only way that works for them is that they can't allow free trade. If they had free trade, then their prices would go to world prices, which is where our dairy product prices are because we've been competitive in the world markets for about 20 years, which is about how long we've had a positive trade surplus with Canada. Canada is the second or third most important destination for U.S. dairy products, depending on the year. Mexico is first. And China and Canada, for the last few years, have kind of gone back and forth between second and third. So if you look at the countries that we've been talking about having potentially trade disputes with, Canada and China are right up there. So that's pretty concerning to the U.S. dairy farmers. Particularly when you consider that we are talking about 16 to 18% of U.S. milk production ends up being exported.
What is the surplus right now with Canada, Chris?
So right now, we actually have a trade surplus with Canada because we got increased access to the Canadian market as part of the renegotiation of the North American Free Trade Agreement, which we now call the U.S. Mexico-Canada Agreement. And so we got access to about 3.6% of the Canadian dairy markets as far as sending exports up there before the big tariffs that they put on kick in. So Canada has allowed limited access, and we have not been super happy with the way they've allocated the access because they've saved a big portion of it for processors. And so you have to ship more raw products up there. They get further processed.
All
But
right, Chris. Yes, you don't tell me you're a Green Bay Packers fan.
absolutely, America's team, the real America's team. But I am old, and I grew up not too far from Platteville, Wisconsin, where the Bears used to have their training camp. If you're a Bears fan, and I remember in 1985, I was in high school when the Bears won the Super Bowl, and the Bears training camp was down the road there in Platteville. They got a lot of attention. That was a really good team, actually, that Bears team. I'm glad they're not that good anymore.
Could you tell us about that with the inputs cost like feeds and vacancies? How much of maximum cost for it right now?
Well, that's a good question, right? Because, of course, we've been talking about what's happening with milk prices, but that's only half of the equation here, right? So, dairy farms, obviously the milk price is the most important determinant of the revenue. Um, if you're doing beef on dairy, those calves are worth quite a bit, and that's been a good source of revenue in the last couple of years. So that's been helping. Cow prices are high. So, maybe it's not as catastrophic if milk prices decline a little bit. Hopefully, they don't do it for too long. But the other side is obviously the cost side, and feed is by far the biggest cost on dairy farms. Another thing that's been happening, right, is that we've seen the corn prices kind of um, have been going down, partly maybe because of some of these trade issues potentially, but also partly right because USDA is at what they estimate 95 million acres of corn. Um, Prospective planning. Now we'll see if it actually ends up being 95 million acres. Fertilizer and some other inputs are getting more expensive, but right now the margin, the profit margin looks for dairy looks probably average to a little bit below average, whereas a couple months ago we were thinking it looked above average. So, you know, feed prices are down a bit, maybe depending, obviously, if you're in the cash market. But one thing that definitely is affecting dairy farms and all other types of farms too, right, is labor has gotten really expensive and it's not going to be going down. And if we do have a trade war, another potential consequence is that machinery and equipment could get a lot more expensive because, similar to the auto industry, a lot of the machinery and ag machinery equipment, tractor companies, and so on have integrated their supply chains between Canada, Mexico, and the United States. And so, if we're going to start throwing tariffs on at the border for things like that, the machinery and equipment are going to get more expensive. Furthermore, all the new machinery and equipment, a lot of it has computer chips in it, depending on what you're buying. And if we get into some dispute with China and Korea and so on, then we're looking at more expensive computer chips, and so input prices don't look great either, I guess, at this point in time.
How concerned about inputs for right now, Chris?
Yeah, no, I'm concerned. I'm concerned about the kind of the squeeze for farmers as far as if we have these lower prices of the goods they're selling, of the crops, of the livestock, of the dairy. If those prices go lower, um, labor prices are not going down. Machinery and equipment is unlikely to go down. I think this might be it could be a tough year. It's hard to see how we'll make the net farm income that USDA was projecting. Of course, they didn't know that all this was going to happen. I think it could be a tough year for a lot of parts of agriculture. Um, there might be some individual commodities that do well, but most of the big commodities are not going to do well in this current climate.
What is your final thoughts on this current situation in the dairy industry?
Sure. Yeah. So, look, I hope that to the extent that this was a negotiating tactic, that the administration will decide to back off, because I don't think anybody's going to win in the long run when we move from a situation where we have all these supply chains that are set up to take advantage of trade relationships that can't do it anymore. So, I'm hoping that this is a very temporary thing and we get back to having competitive markets because U.S. agriculture and in particular U.S. dairy is very competitive and can do well in competitive markets.
Thanks, Chris.
Nice talking to you.
We've been talking with Chris Wolf at Cornell University on back roads of Illinois. Thanks to Chris Wolf from the Department of Agriculture at Cornell University. This has been Back Roads of Illinois. I am Cesar Delgado. You have a great day.